Would you like to know where commercial interest rates are going to be in 2023? It's probably the number one question I'm asked in this rising interest rate environment with a lot of uncertainty. I'd like to take the opportunity today, though, to dig in to some data to see if we can't point to some indicators. Why don't we pick up where I left off on our first segment in December, talking about the yield curve. We basically went through the history of 2022, and now let's catch up, see what happened to the yield curve over the last month, and then we can move on to the future. So we'll quickly go through this, and I'm going to try to keep this presentation down to 5 minutes or as close to it, or at least do a lot better than the 13-minute first one. All right. So last we spoke, I believe it was the 23rd of December. This was the yield curve at that point in time. So let's go ahead and put a pin in it. And let's just see what happens as we kind of click through every maybe 3 or 4 days. All right. We have a slight increase in the short term of the curve and maybe just slight in the longer term as well. Look at that, the 1 month. We're now at between a 4 and maybe 4.25 overnight. Now this is interesting. We're starting to see a big increase in the short-term part of the curve, still completely inverted. A little compression down here, and even we're below where we were a month ago on the 10-year, which is great for all us originators and mortgage brokers. And look at that. Your longer end, your 5, 7, and 10-year now significantly dropping below where we were just a month ago, and the shorter end significantly rising. Even further. So now I say almost the entire yield curve, all the way from about the 6-month down to the 10-year, is inverted. Big indication of where the economy is now and headed in the next 6 months to 2, 3, 5 years. And let's go to today. All right, so here we are today. 4.6% overnight, 1 month so far rate, up from 3.8%. It increased the short end of the curve, really decreased the long end of the curve. This is great for commercial interest rates. You know, the 10 years now about 3.55. A lot of people are saying they're projecting it will hover around 3 for 2023. But then the lender applies a spread over that, you know, anywhere from maybe 200 to, as of lately, I'm seeing spreads of 300 on investment grade deals with long base terms left in their leases, believe it or not. Okay, so this has brought us up to today. And what I'd like to share with you next is a summary of economic projections. This was put out by the FMOC in mid-December, and they'll probably talk about it tomorrow during tomorrow's meeting. But this was a pretty powerful report, and it should help us answer kind of what should we look for in regards to projected bond yields, the Fed overnight rate, GDP, unemployment, and maybe we can take some of that data to help us derive to where we think interest rates are going to be. All right, a lot going on here. I hope that you can see my screen. Let's just talk about a couple of quick items because I do want to move this along. 0.5% growth in real GDP in 2022. Same projected in 2023, and then increasing that growth through 24 and 25. This is a box plot for those that aren't familiar with seeing these type of graphs. You know, we have our entire range And let me step back for a second to provide some insight on where the data comes from. There are, I believe it's 19 federal officials that contribute, and this is made up of 12 regional bank presidents and the board of governors. So some pretty smart people, but it's anonymous. So with the data they provided, that's how we got to these GDP numbers. And this is percent, by the way, in the y-axis. Same with unemployment rates. We're looking at to go up a little bit. Key one here is really the inflation. Here we are now, actual versus projected, real tight range in 2022, because obviously we've experienced that, and they did the report at the end of 2022. The range increases, but it's much lower from where we were and projected to be as time goes on. This is what I think is very interesting, though. This is a dot plot, and there should be about 19 dots on the dot plot. And this is our federal funds rate. So right here in 2022, we're about that 4.25. Everyone's in agreement because it was the new year, and that's where we are. Then we move to 2023. Not a whole lot of disparity, pretty tight range, frankly, but not a lower overnight environment, not necessarily directly indicative of where the bond yields are going to be, but it does give you a strong indication on that short-term money, that floating rate debt, a lot of your construction loans, bridge loans, interest-only loans, are going to be really affected. And then we get to 2024, huge disparity, a lot of unknown. We kind of see here the majority are thinking around 4 to maybe 4.75. I apologize over here. And then 2025 is big mystery. I'd like to know who this person is here. And then, beyond 2025, we're looking at Fed overnight rate maybe closer to 2.5 to 3%. So I'm not sure if that gave us the information we were looking for, those exact numbers on where we're going to be with interest rates, commercial interest rates in the future. I've been told on the residential side, a lot of the mortgages are tied to the 10-year treasury. So if that 10-year treasury stays about 3.5, I think that converts to about a 6 to 6.5% on the resi side. On the commercial, we just apply a spread. As mentioned earlier, I'm seeing a lot of fragmentation within the marketplace, whether it's investment grade deals, structured finance, industrial, multifamily. Certain product types that were bellwethers are now shifting a little bit. So it'll be very interesting, even though I believe bond yields are going to stay down or at least steady, where the lender spreads come in to calculate those commercial interest rates. And let's go ahead and wrap up here, but there was one or two other charts that I thought would be of interest to share. Here's one of them. Our actual change in real GDP, right? This is change. So, and then if you take all the previous data and charted it a little differently, this is your 70% confidence interval. It's kind of weird they use 70% versus like 2 sigma, which would be 66.7%. But I thought that would be very interesting. And then also there was one other chart. Well, inflation. Thought that to be very interesting. The Fed would like it here around this 2% range, but they're projecting potentially all the way out to 2025, we're going to be dealing with these issues and trying to climb back to a more normal state. And lastly, here we are. Fed funds rates. This is the 70% confidence interval. This is the median projection. So in summary, it may be a high interest rate environment for not only 2023, but 2024, assuming no other foot drops, right? Or shoe drops, probably better expression. This is what we should expect. Feel free to give me a holler for any commercial real estate loan inquiries. Believe it or not, we're actually pretty busy. We closed a $100 million plus transaction last week, a couple of sub 10 millions the week before, and actually just signed and went under app on a 28 million and $9 million deal. So it's going to be a challenging 2023, but people are still transacting. Be sure to hit those phones, build some relationships, maintain the current, and we'll see you next month. Make it a great day.